Well, good day, all. Ira Epstein, and here we are with your weekend edition of your financial market wrap-up. And this is the end of September, September 30th, 2022, the end of a week, the end of a month, and the end of a quarter, all at one time. And today the question was how much window dressing was going to be done during the period. And there was quite a bit. Markets were trying the upside, the downside. Overnight, you were getting that rally, and then the market let go. There were some great selling opportunities in the market. If you were looking and you had taken this week my stock index report, it presented opportunity upon opportunity. I hope you took advantage of. If you're a subscriber of mine and the paid one, you know we did. It's fact. I can prove it. I have the recordings. All right. Let me tell you something I've learned. There's nothing like experience. The problem for many of the traders, if you notice you're not hearing about the Robinhood guys, the meme traders, any of that, where are they? Well, let me tell you where they came from and where they're at. You're not hearing any talk about it. They were a phenomenon that began after the Great Recession, the electronic trading, the starting the Robinhood events and all that. So let's go back to 2008. This is 14 years later. The Great Recession, the Fed came to the market's rescue, blah, blah, blah. They took us out of that. They made money easy to get things going. Then the pandemic hit, easier money still. Now the end of the pandemic for America. And inflation high. And now the Fed starts going, So these 14-year traders, that's a long time, have never seen the Fed go, I don't have your back. And the Fed doesn't have their back. In fact, it's the opposite. What had been an embracing Fed, oh, come on, I'll make you okay. Don't worry about that break. We're going to get you right out of this. Now they're punishing you and they can't get it. They'll learn, just the way I learned and others. I've been a broker 53 years. I've been around this horn, done this rodeo, understand it. Bear markets are nasty. And when you think like you got up today to all these good rallies, you think they're good, they're not good. You got this Friday coming out, another set of numbers in the jobs data. Is it going to help the market or hurt the market? You know, so far the jobless claims we just had yesterday, they weren't very helpful. And I'm not seeing that any of these reports are yet showing that the economy's teetered. What has teetered is the stock market. The stock market's in a 25% decline in some of the indices. We are seeing repricing. I don't care if it's an Apple, a Microsoft, a Nike, a Meta stock. They're all under the pressure. At the same time, the dollar has reigned supreme. It has hurt markets that are priced in dollars because they become super expensive. OPEC is meeting this week. At first, I came out this morning and I said, my guess is they'll go for 200,000 or 300,000 barrel decline. Russia wants 1 million, they'll never go for it. And I'm reading on Dow Jones Newswires today about noonish where OPEC is considering between 500,000 and 1 million barrels. I thought they would go conservative, ratchet yourself down. Maybe they won't, I don't know. In the grain market, up 25 cents today in wheat. You had a quarterly stocks report. You're still adding to the yield on interest rates, so nothing has changed here. When futures go down, you keep adding to that. Cotton, because of the price of the dollar, because of the world now pulling in, recessions everywhere, one of the worst Septembers on record for the market. So you're getting those pressures, and you've got to learn how to trade with them. Now, when I look at a chart, and this is a monthly chart, I don't trade off monthly charts or make analysis on it based on much on this, but it's wonderful to see because it's the longer term picture. When you're under the 18-month moving average, it's simple. You should have downside bias. When you're under the 18-day or 18-week average, downside bias, same thing. It all works the same. So the bias is down, and the market has come a long way from 47.58 down to 36.0150. When we come to the weekly chart, If you're listening to what I'm talking on bias, it has certainly kept you in good stead. No question about it if you take a look at what it's done. And here you've gone on a closing basis from 42.81 to 36.0150. And here you are in the S&P at that magic 3,600 level that so many analysts think is going to hold the market from back here, the June lows. It could. Do I think it will? No. I think there could be another, somewhere between 10% and maybe another 5% decline in there. Do I think there's another 25% decline in the market? Unless there's something I don't see, no, I don't. So I think the worst of it's happening, but you don't go from bear to bull. You'll go from bear to consolidation when the bottom is found. I don't know where that bottom is yet. As you can see on a weekly bar chart, you've come down to those numbers. You're in a downtrend. A downtrend could be defined as what is the pattern? Do you have higher highs, higher lows? Isn't that what we were having back here? That was an uptrend. Then when the market turned gears, which it began over here, lower highs, lower lows, and then you didn't go up for those highs again, and you kept setting in with new patterns, because that's what a bear market does, of lower highs, lower lows, and they get more regular. They'll run out of momentum eventually, but you're not at that point. You don't have to agree with what I'm saying, but that's where we're at, in my opinion. The 200-week moving average is always important in a market. Why? Because it's a 4-year moving average. It is not a forward-looking vehicle, it's backward. It is telling you the average of prices over 4 years, and traders like technical tools, and they'll tie into that, and they'll go, that could be a support zone. I can't argue that. Makes sense to me. And when you combine the Bollinger Band with it, very important. Now, at the end of this, I'm going to have for you all my ad on the Bollinger Bands, the enhanced Bollinger Band. If you haven't learned how to work with momentum, as I teach it, tied into the Bollinger Band, you're trading with this hand or this hand behind your back. You don't know what you're doing. You're getting and saying, okay, I'm bearish. This is where I'm going short. This thing's breaking down. And the work is saying that because you only trade 5% of the time outside of the bands, wrong place to do it. Right place to be taking money off the table. Right place to be reselling into the market. Wrong place to be selling down into that. That's all it is. Doesn't mean the market can't go lower. It's the wrong place to be adding to short positions or putting on your first ones. Let the market come to you on the rallies. Let it prove it's done anything. On this simple chart, the big resistance is 39.54. The 18-week moving average of closes. Momentum is down. I don't look at the weekly charts as overbought, oversold. They're pointing up, they're pointing down, or they're embedded. When I come over and I look at the everything together, why would I want you to be short? When you come to the Dow, now you stopped last week, if we come here, and paused at the combination of the 200-week and that. I was hoping to get even more of a rally out of the market. I would have loved to have gotten that. You're not getting it. You didn't get the best type of rally you'd want. As the market's working its way down in the NASDAQ, where are you? The 200-week and that. So I think this week is going to be a telltale week. What are traders going to do going into the jobs data? We don't get the Fed coming out until November 2nd. November 1st, they go into the two-day meeting. The 2nd is when we get the policy decision, whatever it's going to be. It's going to be between 50 basis points and 100. I think we all know that. It's most likely to be 75, which gets the other central bankers around the world following what the Fed does. Have you not seen that? We're the elephant in the room. Everybody else is a small fry compared to America, and our Fed chair isn't looking at what they do, rightly so. His job is us, and that's what he's got to nurture and protect, and that's what he's doing. So when people think, oh, he's going to blink, does that look to you like he's been blinking? And I know what you're going to say, and you're right. You're going to say, Ira, the pain isn't there. if the unemployment numbers get bad, if people start losing their homes and they're fired and all that happens. The problem is this is a different type of recession. This is where people are well employed. You're at a 3.5, 3.7% unemployment. We're hoping that with the Fed action, the Fed is hoping, I'm not saying I said that wrong. The Fed is hoping to get it up over 4%, maybe to 5%. It's going to be a lot of people out of work, a lot of pain. You haven't seen that yet. So that's when the pain comes in, and that's when the Fed feels the pressure, and that's when you start looking at what's going to happen. Where's the trajectory they want now? More pain. So if you want to fight that, God help you, God bless you. I don't want to fight that. In the Russell, maybe one more leg down here, and I'll be looking for a bounce again. So I am in the camp now that has reasons on the chart that I can see that I can make an argument for another bounce. Maybe you come down Monday, and then you try for a Tuesday bounce. The day doesn't matter. I'm not good enough to pick the hour, the day, the minute. It doesn't matter. You're in a zone. That's the thing. Selling short under the bonds down here. You do it. I want no part of that. The market down, I realize it can get a bounce out of nowhere, and it doesn't have to. But I'll go with what I teach. It is rare that you get 5 weeks in a row under a Bollinger Band. You got week 1, 2. This week was 3. Right here, you finished over. That's not it. So you got 3 weeks in a row under the Bollinger Band. That gives me, for the week, a 2% chance, the way that I calculate, of the market staying under the band. Why? I give each full week under the band takes away one of the 5% of the time. Now, the 5% rule is really for the total, above and below. I converted it. It may be the wrong thing, but then I went back, and like I say, I have been doing this for a long time, and I have been working with Bollinger Bands. I learned them from John Bollinger. I used to have him on my TV show. Really nice person. And I just started playing with things different. You know, just because he created it doesn't mean that a guy doesn't build a different type, maybe sometimes a better mousetrap. And that rule does it. Is anything telling me to be long? Nothing. The question is, I'm looking for the bounce. I am not looking to be long. I have no intent of being long. 10-year notes, the same thing. And I look at the market. Dollar index. Well, this should be the resistance zone, and you're getting it. Now, if the red line breaks down under 79, and it hasn't done it, it's 84.5, well, then I'll think that more of a correction's coming. But on the first break now in here, until that number gets and stays under 79, you're going to get buyers in the dollar. They'll come in. Maybe it's 100 lower. I don't know yet. I'll go to the daily charts for the exact points. But that's what I'm thinking is going to happen there. And in the euro, I can make an argument for a bounce, but you have a bearish embedded reading. So the daily charts are always more active. They're going to turn before these, turn up and down. This is a lumbering, slower chart. But what you do is you learn to use the two together, and that's what I do in my morning subscriber videos for my subscribers, obviously. That's why it's called a subscriber video. And we go through that. I've already done for the weekend subscriber videos. This is one of them, but it's not a paid subscriber. I'm saying buy here, sell there, do this. And I show during those the daily and the weekly charts. So if you haven't done this, do yourself a favor, give it a try. I think you'll get an awakening here. In the Canadian dollar, this is a breakout of sideways action. That's what you've had. And how deep it wants to go, I don't know. But again, I wouldn't tell my enemy to go short under a Bollinger Band. You do it. I want no part of it. That doesn't mean it can't go lower. It's just not the way that I teach trading. In the end, this is your support zone. Is the market going to fall out of here again? Well, you've got your embedded reading. Again, you just got it back. Remember, we had a correction just recently. Let's see if I can get this. There we go. It'll keep coming. And the first time the market right here had both numbers under 20 right there. Week 2, week 3. So to get a bounce out of here, that's where the pros are going to sell on the weekly chart. They want to sell the rallies, and they're going to be looking at this market to come back down just the way it is and keep riding that and do that until it loses the embedded reading. The problem is it's just gained the momentum to the downside. In Bitcoin, there's nothing friendly here. I realize how many people love Bitcoin and Ethereum and all these cool things. Okay. You've got now a bearish crossover. What is a bearish crossover? Just pay attention. Watch. Notice how the red line, which is the 18-week average, is just crossing under the 200 right here. When that happens, you normally make a new low for the move. I'm still looking for it. That's probably it right there, but I think you can go maybe a little bit more. And you're embedding again. When it bounces, when it turns, it'll turn. You'll know it because your red line here is going to close over 21 on you, and it's a simple thing to figure it out. Okay, I'm in the correction phase. Until that's over, there's more pain probably coming. The differential between Brent and WTI sitting right now at 847. Now, here's the issue that you have to deal with. OPEC is meeting this week. They're going to make a cut. They're not walking out of that without a cut. That gives Brent a bit more of a bid typically than the U.S., but neither are good. And can I be honest? I was shocked today. After that news, Brent had been up. It actually closed lower on the day. Somebody knows something I don't know on it off the news. Where am I looking for big support? It stares you in the face. The first level is the 100-day average in the lower band. Are we embedded? You sure are. So this market is still in the bear camp. What about WTI? Identical. So you're in your first support. If this fails, the next support is really ugly. And I'm sure that OPEC chartists are seeing this. It could come in from 63.20 to the lower Bollinger Band. This is why they might be talking bigger than I thought. I thought 300,000 barrels, do it in sequences, was enough. They may go big. That would be bullish. If they don't go big, the market's going to test them. Gasoline, you're right there. Market is just riding the 100-day average. So learn the combinations. The combination of a Bollinger Band, 100-day average, 200-day average, really important areas. Does that mean you're a buyer to go up? No, you're under the 18-week average. The trend is down. You just don't want to be short. Well, that saves your ammunition for things you do want to be long or short, and that's how you work with it. But as I told you, you hear me over and over teaching you how important the combination of Bollinger Band and momentum is. The band on itself will not do the job. It's the band and the momentum. I teach it in a 13-video series. You sit there, we give you the charting software. The data you'll see in the videos is obviously old, but the charting software will match up with it. It's live software too. And then in the mornings, because when you buy the course, I'm going to give you 2 weeks free to my morning subscriber videos. If you're not already a subscriber, you'll see it unfold right in front of you, and you're going, oh, that's what he means. Take a look at this, educate yourself. Welcome. I'm Ira Epstein, and I'm here to talk about my enhanced Bollinger Band course. Now, many of you have taken my regular charting course, and if not, you might think you know something about Bollinger Bands. As you know, Bollinger Bands are an algorithm designed to keep the market trading within it 95% of the time. And on a chart, it will offer on the top part resistance, on the bottom support, and the idea is the market will travel within them. We know that sometimes it latches onto that band, goes up or goes down. Well, how do you play with that? Can you pyramid the positions off that type of thinking? Well, I've applied all three of these into 13 different videos that teach you my concept of it. And from that concept, you're able to work with weekly charts and or daily charts. The 13 videos, each about 7 minutes long. The idea here is not to put you in school forever, but to teach. Now, If you haven't tried my complete futures research, I throw that in as well. Whether you've tried this or not, I think it's worth taking a look at. I think you're going to learn something from there. That research, by the way, covers twice daily market updates for you and access to what I call window envelope numbers, which I think are very important when looking at these Bollinger Bands. The next part is a trial to our charting software so you can make your charts look the same way that mine do. It's that simple. Where do you go with it and how do you get all this? It's simple. You go to our website, www.iraepstein.com. If you go to the word education, everything you need is answered there. You can also call my staff. They'll be happy to help you get set up. I'm Ira Epstein, on the road to your education.